What's up, traders, and welcome back to Explain the Charts. Today is November 30th, 2025, and we are diving deep into USDCAD. We'll cover the latest market-moving news and then break down the charts to see what the price action is telling us. The big story right now is the diverging monetary policies between the US and Canada. Markets are heavily pricing in a 25 basis point rate cut from the Federal Reserve next month, which is putting significant pressure on the US dollar. Meanwhile, the Bank of Canada is expected to hold its rates in December, creating a policy divergence that favors the Canadian dollar. This fundamental backdrop is being reinforced by strong economic data out of Canada. Just 2 days ago, on November 28th, Canada reported a stunning third-quarter GDP surge of 2.6%, blowing past expectations of just 0.5%. This has thrown fuel on the fire for CAD strength and has sent the USDCAD pair tumbling. Looking at our daily chart, we can see the broader context of this recent move. USDCAD has been in a powerful uptrend for much of the past year, rallying from lows around 1.33 all the way to a peak near 1.446 back in December of last year. After that peak, we saw a significant pullback before another leg up that topped out just a few weeks ago around 1.417. This long-term bullish structure is important to keep in mind, as some analysts point to the MA200, which is far below the current price, as evidence of underlying strength. However, the recent price action has been decidedly bearish, with the pair declining for 4 consecutive days. Analysts have previously pointed to the 1.4400 level as a major technical ceiling, and we can see how the price failed to reach that level on its most recent push higher. The question now is whether this recent sharp drop is just a correction in a larger uptrend or the beginning of a major trend reversal. To understand the impact of that GDP news, let's zoom right into the action on the 15-minute chart for November 28th. As you can see here, the pair was trading relatively calmly around the 1.4025 level leading up to the data release. Then, the selling pressure hit like a tidal wave. We saw an immediate and aggressive drop, with the price plunging through several key levels in just a couple of hours. The pair fell all the way down to a low of 1.3936 on the day. This is a classic example of how a major economic data surprise can completely shift short-term market sentiment. The selling was so fast that some reports questioned if it was amplified by thin market conditions or even a potential data leak. Now let's switch over to the 1-hour chart to get a clearer picture of the recent downtrend. This time frame really highlights the key levels that have been in play. According to technical reports, the 50% Fibonacci retracement level at 1.40135 was a critical support. We can see right here how the price decisively broke below that level following the GDP news. When a key support level like this is broken, it often becomes the new resistance. So, any bounces in the short term will likely face a tough test right around that 1.40135 area. The price has been making a series of lower highs and lower lows, which is the definition of a short-term downtrend. The recent high was around 1.412, and we've been falling ever since. Volatility has been high, and the momentum is clearly with the bears for now. Let's return to the daily chart to see where we stand in the grand scheme of things. After that massive drop on the 28th, the price closed at 1.3975. This is incredibly significant because it's right on top of a key swing zone identified by analysts between 1.3968 and 1.3975. This area has acted as a major pivot point for price since early October, serving as both support and resistance multiple times. The fact that the price stopped its free fall right at this level suggests it's a critical battleground. This is the line in the sand for both bulls and bears right now. A hold here could be the base for a recovery, while a break below could open the floodgates for more selling. We can also see a few massive wicks on this daily chart from previous flash crashes in October and November, which indicates extreme volatility can appear suddenly. These events can liquidate both long and short positions, so traders must be cautious. So, let's recap and discuss the potential scenarios from here. The primary driver is the central bank policy divergence, which fundamentally favors a weaker USDCAD. This is supported by the recent strong Canadian GDP print. Our key price levels to watch are the support zone at 1.3968 and the new resistance at 1.40135, followed by the 1.4050 area. Let's outline a few possibilities. First, the bearish scenario. I'd give this a 50% chance in the short term. If we see a decisive break and close below the 1.3968 support zone on the daily chart, the next logical target would be the 61.8% retracement level, followed by lower support zones around 1.38. This scenario would be reinforced by continued dovish talk from the Fed or more strong data from Canada. Second, the bullish scenario. I'd place this at a 30% probability. If this 1.3968 support zone holds firm and we see buyers step in, a bounce back to test the 1.40135 resistance is likely. A break above that could signal a failed breakdown, potentially sending the price back towards 1.4050 and higher. For this to happen, we'd likely need some hawkish Fed surprises or a sudden downturn in Canadian economic data. Finally, a sideways scenario, which has a 20% chance. The market could simply consolidate between the 1.3968 support and 1.4050 resistance as it awaits the final central bank meetings of the year in December. This would represent a period of equilibrium as traders weigh the conflicting signals of the long-term uptrend against the recent bearish fundamental news. To summarize, the key levels are critical right now. Watch the support at 1.3968 very closely. Resistance is at 1.40135 and then 1.4050. The upcoming Bank of Canada and Federal Reserve meetings in December will be the next major catalysts for this pair. Keep an eye on the rate differential expectations, as that has been a primary driver of price. Also, remember that USDCAD is a commodity pair, so significant moves in oil prices could also have an impact. Thanks for watching our analysis on Explain the Charts. Remember to like and subscribe for more in-depth chart breakdowns. And finally, a quick disclaimer, this video is for informational and educational purposes only. It is not financial advice, and you should always conduct your own research and consult with a professional before making any investment decisions. Trading involves risk, and you should never risk more than you are willing to lose.